Hey everybody, welcome to Trading Capital's exclusive analysis on natural gas. We're going to be discussing this particular natural gas chart provided by capital.com, and then we'll also flip to the natural gas chart provided by currency.com and then the UNG chart to really give us a grasp. There's some slight variations across each natural gas chart that we'll touch base on, but overall natural gas got slaughtered on OpX. It was down 5.68% on the closing session. It did have a small bounce off the low. The interesting thing about natural gas in terms of its price action, it still remains very oversold. Now, this trend line that I drew in a few weeks ago, it was a much thicker range, and how I had it drawn in was connecting this pivot high over here, plus I had it thicker connecting through this low, and you can see that we did get the bounce off that initial level. But I do think that the trend line that it was supposed to tag was just tagging through this key pivot high and this key pivot high. And now you can see that natural gas has tagged that level once again, and it is bouncing off of that price action. Now, obviously, with a 3-bar surge to a low, natural gas is more oversold. But the big question is, do we get a second daily close below this pivot when price action opens up on Tuesday? If we do, it means that this has now triggered yet again another bear flag pattern, and it likely means that there's more downside to come in natural gas. I specifically added to my UNG. We have informed our members here at Trading Capital that the UNG chart is definitely looking oversold, and we informed you that there is a potential max move downside on UNG that we have calculated around 730 or so. Now, in terms of the UNG price action, what I find really fascinating, if we zoom in on this chart, we can see that UNG pierced this beautiful symmetrical channel, and then it rallied and closed back inside of this epic channel. This is a beautiful support channel in an oversold condition. You had a bounce here, tried bouncing, it was a very weak bounce. The wedge pattern broke to the downside. Now you're trying to bounce again, and we'll see if the momentum can start to finally change to the upside. The importance of analyzing the UNG, I like to see it for the volume flows. We can clearly see that the volume was massive on Friday. Perhaps we're seeing some final liquidations and some final sellout just due to the fact that there were massive natural gas energy bulls calling for this to hit 50 to 100. So people piling in even up here maybe are still finally capitulating at these lower levels. Certainly with the volume trading at these levels, that is showing you that although there's a great amount of sellers in this price action, being that it was a net negative day, it also means there's a large amount of buyers coming in and swooping up. And eventually that sell side pressure is going to abate. And I do think that we'll see that eventual bounce. Now, the importance of natural gas, looking at this capital.com chart, the currency.com chart, this chart is slightly different to the overall natural gas provided by the capital.com chart. If I flip to the weekly chart on this particular one, and just let this load. If we look at the weekly chart of this chart, it's actually fascinating because you do have two key levels. Now, on the weekly chart, it's showing that we actually have not tagged this key trend line. So maybe there's a little bit more downside, but it could coincide with this pivot over here. Now, being the fact that this chart is slightly different to the capital.com chart, which is also a natural gas version, I just like to look at all of them to really get a best gauge of what the sector or what the specific asset class is going to do. So if we do pierce through that level, this first initial trend line, there's actually a longer trend line that I'm watching, and it goes all the way back to a 2008 pivot connecting to your wick high in 2014, your blow off top intersection here, and massive chop and consolidation point over here. If you were to flush down and get another daily low close, this price action is likely going to hit $2 on natural gas, and that is still going to be an accumulation zone. Now, the thing about this natural gas asset class is it's very volatile, and you have to really put to your position management carefully, because if you start going all in on a triple or a double leverage ETF, you could certainly get wiped out. I mean, we've had almost basically a 67% price decline since mid-December or mid November of last year. So an epic decline Definitely one that could wreck a lot of people that have been long this trade from higher levels. And if you were double or triple, you're talking about, potentially 150, 200% out of the money if you bought up here. Now, with position management inside, we are long natural gas and we obviously don't have a full position we're accumulating. These levels are a massive, massive technical trading area that I think will be beneficial to start accumulating at. And to put into perspective, this is not only a swing trade level, but acquiring and building a natural gas position around these levels is really going to capture the upside volatility over the next 1 to 2 years. Even as a trader, primarily we focus on more trading and shorter term plays, but natural gas being at these $2 or $2.30 levels makes sense to accumulate a long position, because we likely will see in like 1 to 2 years, probably 2 years, natural gas taking out these highs. That's kind of my thesis around this particular sector. But overall, we do have an additional support trend line coming down here that we can potentially buy and look for a bounce. But we're watching for that potential confirmed breakdown on Tuesday. Will we get it? Time will tell. That's certainly what I'm watching. Now, a couple things that you can do that I'm exploring. If I get that daily close below, I may hedge my long position with a KOLD or a little bit of a put action to the downside on natural gas, just in the event that we do get another confirmed breakdown and a flush through this level. We're talking about another 11% drop on natural gas. Although I'm still going to be accumulating, I'd rather also try to play a potential technical breakdown that is likely to net us maybe, anywhere between 15 to 20% on the short side. Really, other than that, if you're building a long thesis around natural gas and just accumulating, it's better to accumulate the single ETFs as you don't have to worry about that decay. The thing about the levered ETFs is they do decay over time and they keep going lower and lower. And we don't really know if this is going to be a true bear market in natural gas just due to the oversupply and overreaction that with the Russia and Ukraine, or maybe we get a V-shaped recovery and a massive bounce. But at this point in time, there's a lot of risk associated, especially if we do slip into a Fed-induced recession. I do think that we have to be mindful and careful about what they are saying and that they are likely trying to induce a recession. And typically, recessions are very, very negative for these equities or these commodity sets. And this is probably could be what we're seeing to some a little bit of an extent. Perhaps there's just, again, that oversupply from the war reaction, but we never know if the market is also pricing in a negative recession. Energies do typically reflect it and end up crashing harder and faster than tech and many of the other sectors, especially when they go from an outperforming mode to an underperforming. So, but you are coming up into some big support. There's all support in this range. You're still oversold on natural gas. Nothing's really changed in terms of my bullish thesis. I'm still positioned long. I think that we're going to have a technical bounce at the minimum, but it's all about just inching in, dollar cost averaging, accumulating a position, allocating a specific amount of your portfolio to this particular commodity, and understanding that it could overshoot in both directions. And that's where a good trader and investor allows themselves to build a core position with a great average by not YOLOing all on one single specific level, because ultimately it's very difficult to identify that exact level where you're going to be right, which is why inching in and accumulating a position is going to be a little bit better of a risk to reward setup and not getting yourself killed if for instance, if you put your position all the way up here thinking there's massive technical support, massive pivot zones, which there was, you could be underwater substantially. I mean, we're talking about a potential decline already underwater of 31%. So this is the importance about building a quality average, and that's what sets the average traders to the good traders to the great traders apart. And we were short natural gas. We did make money off of that trade. Now we're flipping back to the long side because it does make sense during this point in time. On that note, I'm going to bid you farewell. Everybody enjoy your long weekend and stay tuned for more price action because I do think it's going to be wild. Now that OpX is finished, I do think that there's a little bit of less manipulation going to happen in the commodity natural gas market, but nonetheless, this market is heavily influenced And certainly there's a massive downtrend that is certainly overpowering much of the buy pressure, but we're getting close to that capitulation, I do think. On that note, take care, everybody, and we'll see you on the charts later.